Welcome to a special edition podcast version of Market Week in Review for the week through Thursday, May 23rd, 2019. I'm Brian Yadao, and as you may or may not know, Russell Investments has a podcast where we discuss global market news, the economy, and key issues and challenges facing today's investors. You can subscribe and listen to our podcast on both iTunes and SoundCloud, and those links can be found in the description. So with that out of the way, today on Market Week in Review, I am joined by Russell Investments Senior Investment Strategist, Paul Eidelman. Paul, it's great to have you today.
Yeah, sure. Thanks, Brian.
So we have three areas I'd like to cover for this week, really surrounding the global economy. First, an update on the U.S. China trade negotiations. Second, your thoughts on some of the latest round of economic data released this week. And lastly, your take on some of the news coming out from the central banks this week. So let's start with trade negotiations. Global equity markets continue to trend down this week as tensions between the U.S. and China remain high since the failed negotiations a couple of weeks ago. So with markets growing more pessimistic and no upcoming negotiations scheduled, where do we stand, and is this different from other fits and starts we've seen in the last year?
Yeah, I think it is a bit different now in that, as you mentioned, we've had an escalation between the United States and China with the lifting of the tariff rate from 10% to 25% on the $200 billion from a couple of weeks ago. But importantly, the news flow continues to trend in a negative direction after that escalation, in that I think first and foremost, the United States and China aren't talking to one another right now, which is, I think, really, really important, because if the negotiations aren't taking place behind the scenes, it really reduces the potential for an immediate deal in the next couple of weeks, and it probably makes it unlikely that we could see a full-blown deal in time for the upcoming G20 meeting in Japan towards the end of June. And so this trade uncertainty seems like it's likely to be a lingering risk that financial markets are going to have to kind of continue to think about and grapple with for the foreseeable future right now. So I think that's a concern. Second, in terms of sort of a new front of the escalation, and Abe Robeson talked about this a little bit last Friday, the United States has started to target some individual Chinese businesses as well. So the important one, which the markets are really focused on, is Huawei, which was added to the U.S. Commerce Department's entity list, which is basically a blacklist restricting the sale of U.S. goods to that company. And that could be potentially quite damaging to their ability to kind of continue as an ongoing concern in a business. And we don't really know what that ultimately means. China hasn't fully retaliated to that U.S. step yet, but if they were to target a prominent U.S. business, or maybe restrict exports of rare earth minerals to the United States, that would just be a further escalation and concern for markets. So I think this continues to be a headwind to market sentiment right now, and it's an incredibly difficult risk factor for us to forecast and predict, but it does look like it's going to be at least a lingering source of concern for the time being.
Does this have any impact on your overall economic outlook?
Yeah, it's a headwind that we're thinking about, because particularly in the fourth quarter of last year, we saw, as the trade concerns escalated, a meaningful hit to business confidence, not only in the United States, but globally, and that sort of filtered into weaker capital expenditure and a weakness in the industrial cycle. So I think it's a downside risk in that regard. We're not really at the point yet in terms of the escalation that we think it would be an end-of-cycle risk, but it could sort of dampen the growth trajectory both in the United States and globally a little bit relative to our prior expectations.
Okay. Moving on to economic news, let's get your thoughts on the latest release of flash PMI numbers. So we've had data from the U.S., Eurozone, and Japan all released this week. What does the data suggest?
Yeah, so these are important numbers. They're for the month of May, and importantly, the surveys were canvassing businesses globally after the trade escalation took place on May 10th. And what we've seen both in the United States, Eurozone, and Japan was actually a weakening of business activity, a weakening in sort of industrial new orders. And when we were talking about this potential headwind to business confidence from the trade war, there's at least some evidence in these flash PMIs that business confidence is slipping a little bit. So those forward-looking expectations measures in the flash PMIs softened a little bit in May. And so I think that's another sort of signal of risk and concern. Generally speaking, the PMIs are still above 50, so we're getting a signal of growth. It's just a weakening of that growth relative to the prior month. And so it's going to be something we have to continue to track here over the next couple of months.
Okay. And lastly, let's touch on another important component of the global economy, and that's the latest activity and thoughts from central banks. So the U.S. Federal Reserve released their minutes earlier this week. We've also heard some guidance from the RBA on its rate policy.
Yep.
What are some of the highlights from central banks that investors should know?
Well, maybe the more interesting one actually is what's happening with the Reserve Bank of Australia that you mentioned. Their Governor Philip Lowe pretty strongly hinted at the idea of a rate cut in Australia at their June meeting. He basically said, we will consider the case for lower interest rates. For a central banker to say that, it's not a committing statement, but it's about as far as a central banker will go ahead of a meeting. And so that was very strong forward guidance that Australia is thinking about a cut to both support their domestic employment picture and also hope to boost inflation a little bit. So I think that was a bit of a surprise to markets just in terms of how forceful that language was. In the United States, interesting, but probably less surprise in that we got minutes from the Fed's May meeting, and it was quite forceful that the Fed is fully committed to remain patient right now and doesn't really see a case for either a rate cut or a rate increase right now. That might sound boring with the Fed being on hold, but the market has the bond market has moved in a quite pessimistic direction here and is strongly of the belief set that the Fed will cut. And so our sense is that pricing is overly pessimistic. We don't really see fundamentals as being kind of consistent or supportive of a rate cut. And if that view were to prove correct, we think that should ultimately lift U.S. interest rates from here. But certainly the bond market's moved a lot here over just the last month or two. We're looking at a 10-year Treasury yield in the United States here on Thursday of 2.32%, which is the lowest it's been since late 2017. So fixed income markets have moved a long way in terms of pricing and some pessimism here. There's certainly risks on the horizon, but we think that pessimism in the bond market is a little bit overblown right now.
Great. We covered a lot of ground today, Paul, but that is all the time we have for today. So as always, thank you for your insights. And for our listeners out there, thank you for joining us. We'll see you next time on Market Week in Review.